Welcome back to another episode of Prime Chartz. What separates the pros from the amateurs in trading is the ability to read and understand the language of the market. And that's exactly what we're covering today. In this advanced episode, we're diving deep into one of the essential concepts in trading: liquidity. If that sounds like something you're interested in, please give this video a thumbs up to show your support, and don't forget to subscribe to our channel if you're new here. Let's dive into the main topic: liquidity. It is important to understand what we mean by liquidity in trading. Simply put, liquidity refers to money. To identify areas of liquidity, you need to ask yourself, where is the money? In the markets, money can only appear in three forms: entries, stop losses, and take profits. Every time you enter a trade, you're adding liquidity to the market. Every time your stop loss is hit, liquidity enters the market. And the same goes for every time you hit a take profit. This is true for you and for every other trader. So, when you're trying to identify key areas of liquidity, what you're really asking is, where is everyone's orders? Where is everyone's take profits? And where is everyone's stop losses? Now, let's turn our attention to practical liquidity patterns and setups that are more likely to influence price movements than other liquidity zones. Spotting these zones on our price charts can add strength to our trading strategies, increasing the likelihood of achieving successful outcomes. The first pattern we should keep an eye out for is one marked by equal lows and equal highs. As the name implies, when prices form highs at the same level, we refer to this as an equal high. Likewise, when prices create lows at the same level, it's known as an equal low. These equal lows and highs come in two main forms: double tops or bottoms and triple tops or bottoms. Now, let's dive deeper into each of these patterns and uncover the psychology behind their creation in the market. We'll start with the bullish pattern. Imagine we have a structure like this. The price recently made a bullish break of structure, pushing upward before retracing back down. However, this retracement didn't reach the demand zone created by the break of structure. Instead, the price formed an internal low, then attempted another push upward. This time, though, the bullish momentum wasn't strong enough to break the recent major high. The price pulled back again, but still couldn't break the internal low, resulting in a double bottom formation. During this phase, many retail traders who rely on chart patterns would have identified the double bottom and entered long positions, placing their stop-loss orders just below the equal lows. This creates a significant liquidity pool. Consequently, as you can see, the price rallied upward, driven by the buying pressure from these retail traders entering long positions. Now, as you might know, smart money often manipulates the market. They create setups that mislead traders into thinking they understand price action, only to trigger their stop losses and generate additional momentum. Now we have a demand zone at the extreme point, alongside a large liquidity pool formed by retail traders' stop losses. In this scenario, there's a high probability that the price will retrace, clearing the liquidity below the equal lows, touching the demand zone, and then reversing to resume its primary direction. So, our approach here is to patiently wait for the price to clear liquidity below the equal lows and touch the demand zone. This provides the confluence factor we look for before entering a trade. Once the market has already swept the stop losses of retail traders, we can confidently enter a long position from the demand zone, knowing that further stop-loss collection isn't likely. As I mentioned, smart money aims to clear out all retail stop losses. That's why we enter after the stop-loss sweep. Let's take a look at a real chart example. The first thing we notice here is the double bottom type formation. And this double bottom forms a liquidity pool as retail traders trade patterns and will most likely place their long position when they see this formation. Below, we have a demand zone from a higher time frame. The smart money enters the market after the retail liquidity has been swept, so we should look to enter only after we see this liquidity sweep on the retail side. Therefore, we anticipate price to gravitate towards the demand zone, taking out the liquidity and then reverse to the upside. We place our long orders at the demand zone and we wait. We see price has activated the buy order and pushed to the upside after a successful sweep of the liquidity. Let's look at the triple bottom pattern. The same principles that apply to the double bottom pattern also apply here. However, in a triple bottom, the price forms three equal lows instead of two. When retail traders spot a triple bottom, they typically enter the market by opening long positions. They place their stop-loss orders just below these equal lows, creating a significant liquidity pool. Since the market's dominant trend is bullish, it often triggers a large number of stop losses to gather the liquidity it needs to continue moving upwards. So, when this liquidity pool, formed by these stop-loss orders and pending positions, is cleared, it presents an opportunity to consider entering a long position from the demand zone just below. This is because at this point, most stop losses have been triggered, leaving a cleaner path for the bullish momentum to continue. Alright, let's move on to equal highs, which fall into two categories: double tops and triple tops. Starting with the double top pattern, this setup often indicates that the bears are in control. For example, after the price breaks a recent structure to the downside, it might rally back up and form two equal highs near an unmitigated supply zone. This area, tied to the previous bearish wave, creates a substantial liquidity pool above the equal highs, mainly from the stop losses of retail traders who entered short after identifying the double top. In this scenario, it's likely the price will push back up to clear the liquidity above the double tops, trigger the sell stop losses, touch the supply zone, and then reverse to resume its bearish trend. The triple top pattern follows a similar principle. Here, multiple stop losses and pending orders accumulate above the triple tops, increasing the chance that price will move up to clear the liquidity above those highs. Once this happens, it can be an opportunity to initiate a short position from the upper supply zone. By this point, the market has likely absorbed enough stop losses from retail traders, making it less likely that more will be collected. Remember, the smart money's main goal is to clear retail stop losses before entering positions, as it increases the probability of a successful trade. Ideally, it's best to enter a position after stop losses have been triggered. And if price doesn't clear the liquidity before reaching a point of interest, there's a strong chance that area will act as a liquidity source, driving further market momentum. Let's test our theory on another real chart example. We notice equal highs formed by a triple top pattern. Above lies the supply zone, and we are looking to enter sells when price reaches the supply zone. Price is still playing around and it has not reached our supply zone yet. Price has formed another equal highs. Retail trader are entering the market and placing their stop losses above the equal highs, making this zone a high liquidity pool. After waiting for some time, price finally sweeps the liquidity and taps into the supply zone, giving us an opportunity to enter short position with confidence after a successful sweep of the liquidity. And we see that price has dropped to the downside, making this a successful trade. Let's move on to the second key liquidity pattern we should watch for in market trends: trendline liquidity. We'll start by looking at the bullish scenario. Imagine a structure like the one shown on the left. Here, the price makes a bullish break of structure to the upside, leaving a noticeable gap in price. After this, the market creates a new high but then retraces downward. It starts to form a series of small, choppy movements upward without any significant liquidity sweeps. The important thing to notice here is the pattern of these small break of structures. The price is gradually moving higher, creating higher highs and higher lows that are quite close together. This forms a trend line from these minor highs and lows. Retail traders who follow trend lines and chart patterns will often enter the market when the price touches this trend line, placing their stop losses just below it. This results in a large liquidity pool forming below the trend line, as many stop losses cluster in that area. As a result, it becomes likely that the price will dip down to clear the liquidity beneath the trend line, triggering those stop losses. Once this happens, the market will likely aim to fill the gap left behind and move toward the demand zone at the extreme of the retracement. This is where we get an opportunity to enter a long position, ideally from the demand zone just below the liquidity pool. At this point, since the stop losses of retail traders have already been triggered, there's no need to clear more. The smart money enters the market after the retail liquidity has been swept, so we should look to enter only after we see this liquidity sweep on the retail side. Let's test this theory on another real chart example to solidify our understanding. We notice that this is an uptrending market, and it is further confirmed by a series of higher highs and lower lows with break of structures to the upside. Below we have the demand zone. Up here we notice this small channel going to the upside, and breaking structures along the way. We already know that retail traders will oftentimes enter their long positions every time the market touches the lower trend line, with stop losses just a few pips below the trend line. And this behavior creates a liquidity pool. Smart money traders only enters the market after the market has swept the liquidity. And from here we anticipate price to tap into the demand zone, sweeping the liquidity below the trend line and push back to the upside. We then place our long position and wait. As anticipated, price taps into the demand zone and reverses to the upside, hitting our TP. In summary, understanding liquidity patterns like the triple bottom, double top, and trendline liquidity can give us a significant edge in trading. By recognizing where liquidity pools are created, often by the actions of retail traders, and waiting for the market to clear these pools, we align ourselves with the smart money approach, which seeks to maximize winning probabilities by clearing retail stop losses before making major moves. To effectively apply this strategy, patience is key. Entering a trade after a liquidity sweep or once retail liquidity has been cleared enhances the likelihood of success. Remember, the main goal is to follow price action with precision, allowing the market to fulfill its natural course before we commit. By consistently identifying and acting on these liquidity patterns, we can increase our potential for profitable entries aligned with the market's true direction.